Buffett Partnership, early days, in 1956, returning to Omaha, Nebraska, a 25-year-old Warren Buffett decided to apply his investment theories. He spent 2 years with mentor Benjamin Graham, absorbing value investing principles. With Graham retiring, Buffett saw an opportunity in his hometown. He didn't start a large fund. On May 1, 1956, he pulled $100 from himself alongside $105,000 from his sister, aunt, father-in-law, and a few close friends. This was the genesis of Buffett Associates, later Buffett Partnership Limited. The structure was simple. Buffett served as the general partner, managing all investments. Limited partners contributed capital and shared profits. His compensation was unique, no management fee unless the partnership's annual return exceeded 6%. Above that, he kept 25%. Below so he received nothing, absorbing losses alongside his partners. His approach was straightforward. He sought undervalued companies, those trading below their intrinsic worth. He bought entire businesses or significant stakes, focusing on their underlying economics rather than market speculation. He was famously looking for a dollar selling for 50 cents. From that modest start, the partnership's capital grew rapidly. Impressive performance quickly attracted more money and partners. By the end of its first year, that initial $105,000 had already grown significantly. This wasn't just about accumulating wealth, but proving a disciplined, long-term philosophy that would reshape investing. Berkshire Hathaway, the turnaround. By the early 1960s, Berkshire Hathaway was a textile company in terminal decline. Its mills, once bustling in New England, faced fierce competition and outdated infrastructure. Warren Buffett had initially bought shares in 1962, seeing value in its assets, but soon found himself entangled in a dying industry. He took control of the company in 1965, hoping to orchestrate a revival, pouring more capital into new machinery and efficiency drives. This was, as he later admitted, a significant error. The textile business was a capital sinkhole, constantly demanding investment just to stay competitive, with meager returns. The true turnaround began not with a textile innovation, but with a profound strategic pivot. Recognizing the futility of fighting a losing battle, Buffett started using Berkshire's existing cash flow, however small, to acquire stakes in other businesses. The first major step was the purchase of National Indemnity, an insurance company, in 1967. This was a critical move. Insurance provided float, premiums paid upfront that could be invested before claims were due. It was a source of capital that required little to no upfront cost from Berkshire itself. This model became the cornerstone of Berkshire's future. Instead of manufacturing cloth, Buffett focused on acquiring profitable companies, often family-owned, that could operate with minimal intervention. Candies, acquired in 1972, became a textbook example, a simple business with strong brand loyalty and pricing power. These early, seemingly disparate acquisitions gradually began to dwarf the original textile operations. Berkshire Hathaway was no longer about textiles, it was becoming a holding company, a diversified investment vehicle built on the steady cash flow of its new ventures. The old mills would eventually close, but the name, once synonymous with the failing industry, now represented something entirely different. American Express, salad oil scandal. The year was 1963, and the world of commodities trading was about to witness a scandal that would rock Wall Street. At its heart was Anthony Tino De Angelis, a flamboyant businessman who ran the Allied Crude Vegetable Oil Refining Corporation in Bayonne, New Jersey. De Angelis had an ambitious plan to corner the market on soybean oil, but his ambitions far outstripped his actual supply. Instead of acquiring vast quantities of oil, De Angelis devised an ingenious, yet utterly fraudulent, scheme. His company stored its oil in massive tanks at the Bayonne refinery. Inside these tanks, De Angelis arranged a system of pipes that allowed him to fill the bottom with seawater, leaving only a few feet of actual soybean oil floating on top. From the surface, the tanks appeared full. He then issued warehouse receipts, claiming ownership of millions of pounds of oil that simply didn't exist. Enter American Express. Its warehousing subsidiary had become a prominent issuer of these crucial receipts. Lenders accepted these documents as collateral for loans, believing they represented tangible assets. American Express, in turn, charged a fee for issuing them, assuming its own verification processes were adequate. The system worked perfectly, until it didn't. In November 1963, when the price of soybean oil suddenly dropped, De Angelis couldn't meet his margin calls. The jig was up. His fraudulent empire collapsed, leaving a deficit of hundreds of millions of dollars in non-existent oil. The fallout was immense. American Express faced the brunt of the liability, having guaranteed these fraudulent receipts. The company, a pillar of American finance, now confronted a catastrophic loss that threatened its very existence, forcing a reassessment of trust and responsibility in the financial system itself. See Candies, brand pow, the black and white box. The elegant script. For generations, that simple packaging has signaled more than just chocolates, it represents a tradition. See's Candies understood, early on, that a brand is not just a product, but an experience, a memory, a feeling. They built an identity so strong, so consistent, it practically became shorthand for quality confectionery in the American West. Walk into a CS shop today, and you step back in time. The checkered floor, the smiling faces, the free sample offered the moment you arrive, these are not accidental touches. They are carefully cultivated elements of a brand strategy established almost a century ago. The staff, often long-tenured, embody a friendly, almost neighbourly charm that contrasts sharply with the often transactional nature of modern retail. This consistent, sensory experience, repeated across hundreds of locations, anchors See's firmly in the customer's mind. Their visual identity has remained largely untouched for decades, a bold choice in an era obsessed with rebranding and newness. While competitors constantly refresh logos and packaging, See's doubles down on its heritage. This unwavering commitment to its core aesthetic and customer interaction has forged an incredibly loyal following. People don't just buy See's, they participate in a ritual, sharing a taste of their own childhood with the next generation. This isn't just about selling candy, it's about selling trust, nostalgia, and a predictable, comforting pleasure. In a rapidly changing world, See's brand power derives from its refusal to change, becoming a stable point in the confectionery landscape. GEICO, insurance empire, GEICO didn't begin as a nationwide advertising powerhouse. Its story starts with a simple, yet radical idea in 1936, bypass the agent. Leo Goodwin, a former accountant, envisioned an insurance company that would sell directly to its customers, cutting out commissions and passing those savings to policyholders. This direct-to-consumer model was a stark contrast to the established industry, which relied heavily on a vast network of local agents. Goodwin founded the Government Employees Insurance Company, or GEICO, initially targeting a niche market, federal government employees and their families. This specific focus allowed GEICO to underwrite policies more efficiently, as these groups were generally considered lower risk. The strategy paid off, and GEICO steadily grew, proving that the direct model could indeed compete. However, the road wasn't always smooth. By the mid-1970s, GEICO faced significant financial struggles, teetering on the brink of collapse due to aggressive pricing and poor underwriting decisions. It was during this precarious period that a then lesser-known investor named Warren Buffett, already a GEICO policyholder since 1951, saw an opportunity. He had long admired the company's fundamental business model. Buffett's Berkshire Hathaway began acquiring shares, eventually taking full ownership in 1996. Under Berkshire's stewardship, GEICO transformed. It embraced mass-market advertising, introducing memorable mascots and jingles that made its brand synonymous with savings. The gecko, cavemen, and rhetorical questions propelled GEICO into the cultural consciousness, allowing it to scale far beyond its initial niche. Today, GEICO stands as one of the largest auto insurers in the United States, a testament to a disruptive idea that, with the right leadership and marketing, reshaped an entire industry. It makes you wonder what other seemingly unchangeable business models are ripe for such a transformation. The Washington Post Company. In 1933, E.G. Mayer, a financier with no prior newspaper experience, purchased the Washington Post at the bankruptcy auction. His family would guide the paper through decades, transforming it from a struggling daily into a national force. It was under his daughter, Catherine Graham, and editor Ben Bradley, that the Post truly forged its legendary identity. The paper found itself at a crossroads in 1971. When the New York Times was enjoined from publishing excerpts of the Pentagon Papers, a secret government study detailing the history of U.S. involvement in Vietnam, the Post received its own copy. Facing immense legal pressure and the potential ruin of her company, Catherine Graham, against strong legal advice, made the courageous decision to publish. The Supreme Court ultimately sided with the Post and the Times, upholding the freedom of the press. Then came Watergate. The relentless reporting of Bob Woodward and Carl Bernstein, championed by Bradley, exposed a web of political corruption that ultimately brought down a presidency. These two seismic events cemented the Post's reputation for aggressive, independent journalism, solidifying its place in American history. For decades, the Graham family steered the Post through media shifts and economic challenges. But by the early 21st century, the digital age presented a new set of existential questions. In 2013, after 80 years of family ownership, the Washington Post Company was sold to Amazon founder Jeff Bezos for $250 million. This acquisition marked a dramatic pivot, trading a century of journalistic tradition for the deep pockets and technological vision of a global tech titan. It raised questions about the future of traditional news institutions, and how an internet empire might redefine what a newspaper can truly be. Coca-Cola, the classic hold. Few brands command the immediate, almost visceral recognition of Coca-Cola. The distinctive red, the Spencerian script, the contour bottle, these elements transcend language, instantly signaling familiarity across cultures. For over a century, this ubiquitous soft drink has woven itself into the fabric of daily life, from corner stores in bustling cities to remote villages. It isn't just a beverage, it's a global icon, a testament to enduring marketing and product consistency. The perceived secret formula certainly contributes to its mystique, but the true brilliance of Coca-Cola lies in its unwavering commitment to a core identity. While it has diversified its portfolio significantly, the classic taste, the original Coke, remains largely untouched. This steadfastness creates an anchor point for consumers, a reliable, nostalgic experience they can count on. Generations have grown up with it, associating it with celebrations, simple pleasures, and shared moments. This consistent presence transforms a simple refreshment into a cultural touchstone. This classic hold isn't accidental. It's the product of meticulous brand management, ensuring that wherever you are in the world, a Coca-Cola tastes like a Coca-Cola. That consistency, combined with an unparalleled distribution network, has solidified its position as a beverage powerhouse. The brand expertly markets not just a drink, but a feeling: happiness, togetherness, refreshment. They reinforce this image through omnipresent advertising, subtly reminding us of its enduring place in our lives. Yet, even a company so deeply rooted in tradition must constantly navigate the shifting tides of consumer preference and health trends. How does Coca-Cola continue to innovate without alienating its vast, loyal base, and without losing that essential classic essence? Wells Fargo, banking bet. For decades, Wells Fargo built a reputation on stability, a prudent, even conservative approach to banking. But behind this veneer of reliability, a different kind of ambition took hold, fueled by a relentless strive for growth. The bank's leadership, particularly former CEO John Stumpf, championed a strategy known as cross-selling. The goal was simple: get each customer to open as many different Wells Fargo products as possible: checking, savings, credit cards, mortgages. This wasn't just encouraged, it became an obsession, enshrined in the infamous GR8 initiative, aiming for 8 products per customer. This directive trickled down, transforming into an unbearable pressure cooker for frontline employees. Unrealistic sales quotas became the norm, with staff often forced to meet daily targets or face severe repercussions, including termination. Many reported working extended hours, skipping breaks, and even cold calling family and friends, all to avoid falling behind. Faced with impossible demands, thousands of Wells Fargo employees made a critical choice: create accounts without customer knowledge or consent. They forged signatures, opened debit cards people never asked for, and transferred funds between accounts, often incurring fees. Millions of these phantom accounts were opened, an elaborate fraud designed to meet targets and keep jobs. What began as an aggressive sales strategy morphed into a corporate scandal, revealing the destructive power of a culture that prioritized profit above all else. The banking bet had gone catastrophically wrong, leaving customers betrayed and the bank's trust in tatters. The question then becomes, what are the lasting lessons when a financial giant loses its way so dramatically? BNSF Railway, freight giant, across North America. The rumble of a freight train often signals the immense reach of BNSF Railway. Formed in 1995 from the merger of Burlington Northern and Santa Fe, it immediately became a titan of the rails, consolidating 2 vast, historic networks into a single, dominant force in the western United States. Today, BNSF operates over 32,500 route miles, connecting 28 states and reaching into Canada and Mexico, effectively serving as the backbone of the North American rail freight system. This sprawling infrastructure isn't just tracks and trains, it is the critical artery for a significant portion of the continent's commerce. From the agricultural heartland, BNSF hauls grain, coal, and other bulk commodities to market. Its robust intermodal services, moving truck trailers and shipping containers by rail, link major ports on the Pacific coast to distribution centers deep inland, efficiently transporting everything from consumer electronics to fresh produce. It also moves vast quantities of industrial products, chemicals, and thousands of finished automobiles daily. Every day, hundreds of BNSF trains, some stretching for miles, crisscross the landscape, carrying goods worth billions of dollars. This constant, high-volume movement underscores its vital role, not just as a transportation company, but as an indispensable engine driving economic activity across the nation. Maintaining such a vast, intricate network and ensuring the fluid, on-time delivery of goods across continents demands relentless innovation. It is a continuous optimization challenge, requiring massive investments in technology, infrastructure, and a workforce dedicated to keeping this freight giant moving. IBM, a Tech Detour. For decades, IBM didn't just sell computers, it defined computing itself. Known as Big Blue, The company built an empire on mainframes, creating the very backbone of enterprise and government operations worldwide. Its name became synonymous with business technology, a titan that dictated standards and innovations. Then came the personal computer, an invention that would fundamentally reshape the industry. IBM, the established giant, approached this burgeoning market differently. Instead of building everything in-house, as was the tradition, they famously outsourced key components for their groundbreaking IBM PC. They turned to a small company called Microsoft for its operating system and Intel for its processor. This decision, while strategically sound at the time for speed to market, inadvertently sowed the seeds for two future tech giants. IBM gave away the keys to the kingdom, establishing an open architecture that democratized computing and ignited a new era of innovation beyond the direct control. Over the following decades, IBM would gradually cede its consumer hardware ambitions, eventually selling its PC division to Lenovo. It shifted focus dramatically, transforming into a powerhouse of IT services, enterprise software, and now cutting-edge artificial intelligence like Watson. The company that once dictated the future of office technology now operates largely behind the scenes, a testament to how even the most dominant players can choose a path less traveled, reshaping not just their own destiny, but the entire technological landscape in unexpected ways. Apple, the modern gem. For millennia, the apple has held a singular place in human history and culture. More than just a fruit, it became a symbol of knowledge, temptation, and health, etched into myths and folklore across continents. Its journey began not in a polished orchard, but in the wild, rugged forests of Central Asia, specifically the Tian Shan mountain. Here, its ancient ancestors, the Melissiveraceae, grew, their genetic blueprint carrying the seeds of countless future varieties. From this cradle, explorers and traders carried the apple westward along the Silk Road, a living cargo that adapted and diversified with each new climate. The Romans refined its cultivation, propagating specific varieties, while medieval monasteries maintained vast orchards, preserving invaluable genetic lines. By the time European settlers reached the Americas, the apple was a global citizen, ready to put down new roots. Today, after centuries of careful breeding and cultivation, the apple is a cornerstone of global agriculture, with over 7,000 known varieties. It thrives in diverse climates, from the sun-drenched valleys of Washington state to the fertile plains of Europe. Beyond its undeniable nutritional value, a simple, convenient package of fiber, vitamins, and antioxidants, the apple embodies an ongoing agricultural triumph. Its unassuming presence belies a complex history and an ever-evolving future, continually adapted to our changing tastes and environmental challenges. This enduring adaptability, its silent resilience, truly makes it a modern gem, a testament to nature's capacity for evolution and our own ingenuity in nurturing it. It begs the question, what new forms will this ancient fruit take in the next millennium? Occidental Petroleum, recent energy focus. Occidental Petroleum, or Oxy as it's often known, has long been a powerhouse in the oil and gas sector, particularly within the vast Permian Basin. This immense shale play remains the bedrock of their production, a strategic asset generating significant cash flow. But in recent years, Oxy's energy focus has expanded, charting a course that looks beyond conventional extraction. Under CEO Vicky Holub, the company has made a highly visible pivot towards decarbonization technologies. They are investing heavily in carbon capture, utilization, and storage, or CCUS. This isn't merely about ticking environmental boxes, it's being framed as a core business driver. One of their most ambitious projects involves direct air capture, a technology designed to pull CO2 directly from the atmosphere. They envision building multiple large-scale DSC plants, starting in the Permian itself. This focus isn't an abandonment of fossil fuels, but rather an attempt to reconcile their ongoing production with global climate goals. Oxy sees an opportunity to use the captured CO2 for enhanced oil recovery, or AIR, a process where injecting CO2 helps extract more oil from existing wells. This creates a circular economy model of sorts, where emissions are offset or reused. The strategy positions Oxy as an energy company capable of producing vital resources while also addressing the very emissions those resources create. It is a bold bet on the future of energy, and one that challenges traditional notions of what an oil major can be.